Now, if you took that same $10,000 and invested it at 10% for 5 years.
Or 100,000.
Oh, or 100,000.
Yeah,
it doesn't matter what the number
we're
is.
using, yeah.
Yeah, well, I used 10 in my most recent example.
Right.
I know because I read it off my paper here. But
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
Episode 27.
hello, and welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst.
I'm Buzz Leverage.
That sounds about right. We're filming this on November 14th, I believe. Is that right?
No,
16th?
Yep.
Yeah,
You would have got it eventually.
I am Buzz Jeffrey, apparently. and this is the third episode that we filmed in a row.
That's right.
Hopefully-
And today we're going to talk about something that's fairly complex and that two real estate investors who've been drinking probably shouldn't address, but what the hell? Here we go.
Right. So what we're going to talk about is the difference between the equity multiple and the internal rate of return.
All right. Are you confused yet?
So the reason I wanted to bring this topic up and talk about it is because...
Besides, it was the only thing that came to your mind this morning when we were figuring out show topics.
Well, no, I come up with the other show that we filmed today too. So it's actually the second thing that came to my mind. But no, so the reason I wanted to talk about this actually is I've been seeing a lot of syndicated real estate deals where they've put the internal rate of return and the equity multiple side by side. Mm-hmm. And frankly, I didn't even know what an equity multiple was until last week when I decided to Google it and figure out what they were talking about.
A somewhat common theme with the show. When you don't know the answer,
Google it.
Yeah.
Yeah, that's and hopefully when you Google the question of what's the difference between an equity multiple and an internal rate of return, you'll come up with this video.
Yeah.
So anyway, well, this is a little bit complicated. It's not impossible, and actually after digging into the topic, I think it is actually very relevant to our viewers.
No, it is.
First, I think we could start by maybe defining the equity multiple, and then we'll define the internal rate of return, and then we can talk about the differences. So, Brian, what is an equity multiple?
It's the ratio used to determine cash flow over the life of an investment, which in
English means...
how about Spanish?
Okay, you know what? So here's how it's calculated. You take your total profit and total equity and you add the two of them together.
And you divide it.
Divide it by the equity you invested. So if you invested $1,000 into a project and you got $2,000 back, you would get 2,000 divided by 1,000, and that would be a 2.0
equity
multiple. It's essentially a multiple of the amount of money that you get back based on what you invested. So if you invested $100, you got back $500, it's a 5.0.
Yeah, it's essentially sort of a back of the napkin calculation that you can use when you're sort of evaluating these things that I would liken possibly to a gross rent multiplier.
Similar to the gross rent multiplier. I mean, obviously a different function, but the same kind of concept. Yeah. It's not a perfect measure because it doesn't take into account the time value of money. So if I invest $100 now and I get back $200 100 years from now,
it sucks.
It's not a good return. Yeah. If I invest $100 now and I get back $200 tomorrow, it's a really good return.
Yeah.
So the equity multiple in both of those cases would be 2.0.
Right.
But one is obviously better than the other. And that's sort of the shortcomings of the equity multiple. But it is very useful when comparing, say, two investments that have a 5-year horizon, and you're going to invest $100,000 into something for 5 years, and you look at the equity multiple, and one it's 2.0 and another it's 2.5. You obviously want to go with the one with the higher equity multiple.
Once you factored in for all the variables, risk of the investment, et cetera.
Of course, yeah. There's a lot more to evaluate.
But it's a useful tool in terms of doing let's say a 10,000 foot.
It just gives you a general rule of thumb that you can look at and say, hey, I don't even want to talk to people unless I'm going to get at least 50% more money back or whatever it is. The other thing about it is too, like, and this is where the time value of money comes in. In my scenario, if you're investing $100,000 and you're getting $200,000 back over a 5-year period, it does matter if you invest $100,000 and you get $150,000 back on day one, and then you get $50,000 on day year 5 versus you invest 100,000 in day 1 and you get 200,000 on year 5. Those make a difference in the internal rate of return. And that's why we wanted to make this video about the difference between the two. So an internal rate of return, when you take the classic financial definition, is the discount rate such that the net present value of all cash flows is 0.
And in English, translated.
Yeah, right. So that means nothing to most people, I realize. It's, in fact, I put in my notes here, it's basically meaningless.
Yeah.
It doesn't even mean anything to me. But it is important because that is the formula that's used to calculate it. So when you use like Excel, there's an IRR function that you can use, and you should just Google this and watch our YouTube video on how to do it because it's kind of complicated. But basically, you take a stream of cash flows. Say you invest 100,000 in year 1, and you get 10,000 a year for 5 years, and then at the end of 5 years, you get $100,000 back. In that scenario, the IRR, if I'm doing the rough math, would be 10% because you made 10% each year for 5 years and got $100,000 back.
So an IRR is a useful tool for comparing against maybe other assets that you might invest with. And in looking at them, you say, well, if I want a 10% return on my money, to use your example,
right.
Whether it be interest from a bank, which you're most certainly not going to get in this market, or, something else, the stock market, bonds, etc.
Well, and actually that's, the bank thing is actually an interesting thing to bring up because really, if you want to think about an IRR in English, it's what would a bank have to pay me in interest to get the stream of cash flows that I project. So it could be I invest 100,000 and I get 110,000 back after 1 year. Well, that's an easy math problem. It's a 10% return to do that. But if you had a 10% IRR, that doesn't mean you get 10,000 back each year because it compounds over time.
Right.
So for a bank, if you put $100,000 into an account that paid 10% interest, after 2 years, you'd have like $121,000 because you'd get interest on the $10,000 as well. And that's what the IRR is. It's the interest rate that's required to produce the value that you receive over time. And so it's a little bit complicated, but it's really, that's how I think about it. It's like, what would if I got this stream of cash flows in the same day that I got it, I deposited it into the bank, how much return would I be getting?
Exactly. It's an alternative investment analysis against other assets compared to the one you're looking at investing
Right.
in.
So if you're looking at 2 investments of the same amount of money for the same duration, you would want to take the one that has the higher internal rate of return, assuming that they had the same risk, because you want to look at the risk profile, obviously. And that's an entirely different show, which we're not doing right now. So that's that's sort of the difference. So if you think about, let's talk about some examples just to make sure it's clear. And we're going to make this as clear as possible. If you were to invest $10,000 at an internal rate of return of 10%, after 1 year you'd get $11,000 back, right? In that scenario, because you invested $10,000 and you got $11,000 back, your equity multiple would be 1.1, right? Because you got 1.1 times your investment back. Now, if you took that same $10,000 and invested it at 10% for 5 years.
Or 100,000.
Oh, or 100,000. It doesn't matter what the number
we're
is.
using, yeah.
Yeah, well, I used 10 in my most recent example.
Right.
I know because I read it off my paper here. But if you took that money, whatever, and invested it at 10%, let's say it was 10,000 just for simplicity, and you invested it for 5 years, at the end of 5 years, even though the IRR would still be 10%, you would have $16,100 back. Or if you invested $100,000, you'd have $161,000 back. Either way, your equity multiple would be 1.61.
Yep.
So you'd get 1.61 times the amount of money that you invested back. Now, if you're just looking at 2 investments and you're saying, I want to invest this $10,000 or $100,000, and you were just looking at the equity multiple, you'd say, well, I definitely want 1.6 times my money back versus 1.1 times my money back. But that might not necessarily be true. Because what if the investment paid a 10% IRR and you got $1,000 a year in interest payments?
I'm past the point of thinking about that kind of math.
Too
right
complicated,
now.
yeah. All right. Well, listen. So the point is, there is a difference between the IRR and the equity multiple. And when you're looking at the difference between the two, what you need to think about is that the IRR is going to incorporate the time value of money into the deal, where the equity multiple is just looking at how much money you get back over any period of time.
Making the IRR probably a little more useful.
That's right. But I think it also, in fairness, if you're looking at two different investments and the IRR on one is like 100%, you might say, well, that's amazing. But if you can only invest like $1 and get 100% return, the equity multiple might be more useful in that. Although in that scenario, it would still be a 2.0 equity multiple. So you have to look at both, I think, when you're comparing investments. That's really what I would say.
Yeah. So having said all this now, I'm not 100% sure we've actually totally clarified the big differences. The small points, yes, but...
That's probably fair, yeah. Which is why you should not
But
drink.
we've taken minutes explaining it and created another episode, and we're glad you watched.
Is there anything that you think we missed?
Not at all.
All right. I think Brian might be a little bit more buzzed than Jeff in this episode. So what I think is important is to understand that when you're looking at investments, there is no one measure that matters.
Yeah.
The IRR is important, the equity multiple can be important, but at the end of the day, what really matters is to evaluate the investment based on your own personal risk tolerance and your own personal expectations of return and determine if it meets your investment goals.
And then I would also add on to that to evaluate them using the same tools on each evaluation.
If you're comparing one investment to the next, it's important to understand the strengths and weaknesses of the various tools. We did another episode where we talked about return on equity versus return on investment, and it's a similar concept. So when you're looking at your personal investments, whether you're investing in a syndicated real estate deal where someone's telling you this is what the IRR is, and if that's the case, be skeptical. Because IRR and return on equity and equity multiples all assume that the person can sit here and look forward into the future and say, this is how much money you're going to get, this is when you're going to get it, and this is how much we're going to get on sale. And we don't know those answers necessarily. No. So be skeptical about that when you're making those assumptions. Or if you're investing in your own deal, think about these ratios, the return on equity, the return on investment, the IRR, and recognize that they're tools, they're not the answer.
That's right. That's right.
All right, so that is all I have to say about the equity multiple and the internal rate of return. If this is confusing,
Google it.
Or put a note in the comments and we'll do our best to answer the questions.
Thanks for tuning in. We'll see you again.
Cheers.
Cheers.